Today, I'm going to be revealing the exact strategy that me and my team have spent the past 3 years creating and formulating to build passive income from Uniswap v3 concentrated liquidity pools. Let's dive right in. Now, I've shared this strategy countless times in my DeFi Legacy program, but only once on YouTube, and it was not on this YouTube channel. So the first thing that we're going to do is head over to the Uniswap website. And the reason why is because that's the backbone behind this entire strategy. Uniswap is a decentralized exchange where you can swap one asset for another cryptocurrency asset. So somebody that wants to trade Ethereum for USDC can pop into Uniswap, trade Ethereum for USDC, and pay a very small fee. A lot of the times, that fee is about 0.3%. That's compared to 2% that you would typically pay on a centralized exchange like Coinbase or Binance. So obviously the fees are much lower for those trading on Uniswap, which gives people a reason to trade over on Uniswap. The secondary reason is, of course, they are using the primary markets. They're using decentralized exchanges where all the liquidity is stored. They're not using centralized exchanges. They are swapping directly on the blockchain. So if you have a cold wallet like me, like a Ledger Nano X or Nano S or a Trezor or any other cold wallet, you can swap directly through that wallet without having to go and send your assets to another wallet address like a centralized exchange, execute a trade, and then send them back to your cold wallet. But the best part is, and here's where we can create passive income, people like you and me can go on Uniswap and provide liquidity without having to have any capital requirements, without having to submit to any KYC information, and do it directly from our cold wallet. So we still have self-custody of our capital. So we can head over here and do something like Ethereum and USDC. And by providing liquidity for Ethereum and USDC, we are able to earn the trading fees that those people are paying. Now, what I will say is the tighter that we select our price range, the more fees we are going to get, whereas the broader we select our price range, the less fees we are going to get. That's because of capital efficiency. We could provide liquidity on every single possible price point by just selecting full range, but when we end up doing that and provide on every single possible price point, now our capital is distributed against so many different price points that whenever transactions happen on the current price, we barely have any liquidity on the current price. Whereas if we were to go with a tighter range, let's just say we were to choose a range of 1,000 to 3,500, which is considered a broad range still, we have more capital on each individual prices, which means when there is trading activity on current prices, we are going to collect more returns. Anyways, that's the very basics of liquidity mining and how you can actually earn passive income through liquidity pools. Now I'm going to be diving into strategy today, but if you guys are looking to learn more about liquidity mining, specifically on Uniswap, I am going to leave a link down below, a link where you can get access to my Uniswap liquidity mining course, along with 30 days of pro access to Metrics Finance for the small price of $49. Keep in mind, Metrics Pro is $40 a month, and you're also getting nearly $1,000 worth of information just from this Uniswap liquidity mining course. So there's obviously a lot of value there. That link will be down below in the description. But I want to start to dive into some strategy. The first thing that I'm going to do is head over to the Uniswap info page. We can do that by heading over to Uniswap and going to explore. And from here, we can start to find different cryptocurrency assets, or we can use crypto assets that we already know. So for example, if I wanted to look amongst the Fetch AI liquidity pools, I would just type in FET, and I could go down over here and look at pools. This is going to show me Fetch AI liquidity pools. Like we have FET to Ethereum over here. We have Wrap Bitcoin to FET. These ones don't seem to have a lot of liquidity in them. But what I also want to do is go over to the tokens so we can start to identify some big movers and ones that have a lot of liquidity in them, but also have a lot of volume over on Uniswap. So on the tokens page, we're going to see assets like Ethereum, obviously, because that's the most traded asset on Uniswap. And then we're also going to see some stable coins along with Wrap Bitcoin and some more stable coins. But when we start to get further down the list, we'll identify assets like Arbitrum token that has a lot of trading volume. We'll identify stuff like Nero that also has a lot of trading volume, but seems to be a meme coin, or assets like Maker, Matic, USD Plus, and there's so many other assets we could keep on going down this list. The thing is, we want to identify assets that seem like they have some promising potential. And the way we could do that is by starting to just select ones that we come across that don't seem to be meme coins, because I personally don't like to invest into meme coins because they are very speculative, and in all honesty, you're better off taking your chances at the casino in Vegas. But the Uniswap webpage will give you some information about this cryptocurrency. Like Maker is a crypto depicted as a smart contract platform, works alongside the DAI coin, which DAI is a stablecoin, and we can keep on going down this list. It's just going to give us a bunch of info about Maker token. We can also head directly over to their website to see more about what Maker is. Now, let's just say we do want to pursue a liquidity pool with Maker token. We can head over to the pools section and start to identify different liquidity pools over here. We'll see a bunch of information about these liquidity pools, but what we're not going to see is the return that we could potentially get. Yes, we see this 1-day APR over here, but this does not give us a lot of information information considering that everybody's going to have a different range. So how do we know that this APR right here is going to be accurate? That's exactly where my software Metrics Finance comes into play. Remember earlier that I told you that you can get a pro subscription bundled into my Uniswap liquidity mining course? This is exactly what I'm talking about. So what I'm going to be showing you today is under that pro subscription. And you could just go purchase the $40 pro subscription, but you're not going to get access to the Uniswap liquidity mining course as well. Anyways, the first page that we're going to head over to is the Discover page after launching the app. And since this is a Uniswap liquidity mining video, we're going to select every single network that Uniswap v3 supports because we're looking for concentrated liquidity pools. Now, I identified the asset maker over here. So if I want to, I can look at this must include as well as include and just type in maker. Basically, must include will show me positions that exactly include maker. Whereas if I wanted to look at stuff that included maker, render, GRT, stuff like that, I could type that in under the include section and it will show me a list of all the pools that include one of those assets. But for this example, we're just going to be looking straight at maker. We see some different liquidity pools. These ones are all on the Ethereum network. We see Ethereum to maker over here with a 22% APR roughly. We also see Ethereum to maker with a 21% APR. These two are different fee tiers. Now that fee tier is exactly what's charged to the trader when they execute a trade. So if I were to go and trade maker over here on Uniswap and trade it with Ethereum, I'm going to pay a fee depending on what tier I'm routed through. Now if we take a look over here and hover over Uniswap API, you can see I'm routed through the V3.3% pool. Whereas if I were to execute a pretty large trade of let's just say $230,000, I'm going to be routed through a couple different fee tiers. That's because Uniswap tries to get the best outcome for a trader, and sometimes it is better to go through a 1% fee tier as opposed to a 0.3% fee tier. That's if there's a lot of slippage because there's high trading activity or high volatility, or even if the price is just different on one pool than it is on the other pool. Basically, it will use that algorithm to get the prices back intact and get them back to where they're equal to each other, because technically these are two different liquidity pools. Anyways, we would want to choose the higher paying one in my opinion. We also have maker to die, but that's not really doing anything in terms of the actual APR, but we can bookmark it as well. Now from here, we can start to simulate these liquidity pools, and I'm going to dive into how we can actually identify different liquidity pools by using Metrics Finance in just a second. But under the simulate page, we can select our price range, which is something along the lines of, let's just say 1.5, and then over here, we use a range of 1.4. The reason why we might want to do this range is because that keeps us in range for the past 14 days or so, but at the same time, it gets us a much higher APR. One thing that we have to pay attention to with using Metrics Finance is the volume history. You can see there's not much consistency when we're looking at the volume history. There's some high volume days over here, but more recently, there's not high volume days, which is why I would want to use a 10-day calculation range to factor out all of those high days and choose the amount of volume that's being factored in. This is the secret sauce right here. If you can't choose which days are being factored into your calculation, you cannot accurately assume what APR you're going to get. Like we just initially looked at 150% APR, that's what's going to be displayed on all the other platforms. But when we actually dive into it, we're getting roughly a 70% APR, which is why this tool is so important and powerful. We'll dive into all that information in just a second, but I want to head back over to the Discover page and just clear my filters so we can start to identify some different liquidity pools. The first thing that I'm going to do is I'm going to type in ETH, I'm going to type in Sol, as well as I'm going to type in Matic. These are three different assets that I am personally bullish on. Now, I have these under the include section because I want to look for liquidity pools that have these in them, but I also want to look across pools that maybe be something like wrap Bitcoin to Ethereum or wrap Bitcoin to Sol or Maker Ethereum, stuff like that. So we're going to just leave it at that. And then we're going to go over to the TVL section and put higher than $1 million because I want to look at stuff that has a high amount of liquidity in it. I don't want to look at stuff that's super low liquidity and could end up losing me money basically because I'm investing into low liquidity pools and I could end up being exit liquidity. That's not something that I want to dive into. The next thing that I'm going to do is take a look over this volume to TVL column, and I'm going to sort by the highest volume to TVL. So this is essentially judging our average daily volume over the past 30 days against the overall TVL. So there's $40 million in volume right here on a daily basis on average, yet there's $3 million in TVL. So it's essentially expressing that as a percentage. So typically what I do is I sort by highest and then I dive into the middle page, which we have 37 different pages. So I'm going to dive into page 18 and I just kind of find the middle value. And it looks like the middle value is roughly 2.58%. So I'm going to put higher than say 5%. So that way I can filter out a lot of these different liquidity pools because I do not want to scroll through 350 different pages of liquidity pools. This is going to show me ones that that have high trading activity compared to their liquidity amount. Now, there's still 134 different liquidity pools here. That's still a lot of different liquidity pools that I'm going to have to sort through. So I'm going to start to evaluate different opportunities. I'm going to sort by the APR, and I already off the bat see some stuff that's like 0%, 0.01%. One thing I noticed off the bat against these different liquidity pools is they have a low APR because Metrics Finance is assuming a plus 25%, minus 25% range. We actually dive into them and then we adjust our range to something super tight. We are going to get a little bit higher of a return. This time it's now 0.4%, but still not worth it in my opinion. Those are kind of stablecoin liquidity pools, so that's just something that we need to keep in mind. So I'm going to do fees APR higher than 15%. That brings me down to about 109 different pools, and if I want to sort through a couple less, I could do higher than 20%, and that brings me down to 103 pools. Not a big difference, so let's just look at 15%. We can start scrolling through these opportunities, seeing what assets we've heard of before and what assets might make sense in a liquidity pool. I see Sol to Ethereum right over here. It's doing 15.83%. Remember, we can dive into it by clicking simulate, and as we're simulating it, we want to adjust our price range because this assumes a standard broad price range, so that way super high APRs are not displayed over there. But when we actually dive into it and adjust this price, you'll notice that APR is going up because we're going with a tighter range. I'm going to put my max price at 18.5 over here, and I'm going to put my min price at 16. That will weight me a little bit more towards Sol. The reason why we might want to have a little bit more Sol in the liquidity pool is if we're more bullish on Sol. Because take a look at this. If we have 60% Sol when we're starting out in this liquidity pool, when Sol goes to, let's just say, $150 and Ethereum stays the same, we are going to have $1,030 in the liquidity pool. Now, if we were to have a range where we have about 50-50 of each asset, let's just say, we are going to have $1,020 in the liquidity pool because of the fact that we didn't have as much Sol. Now, the thing is, you'll notice that there's a big discrepancy between if we were to just hold our initial assets versus if we're in the liquidity pool. That's because in this example, we're assuming that the price of Sol goes up and Ethereum stays the same, which a lot of the times is not the case considering these have an 88% correlation ratio. These are very, very correlated over the past 30 days, which means when one's moving up, the other one is typically moving up as well. So there isn't any huge worry about any crazy divergence loss unless, of course, Sol or Ethereum diverges from one another because one does very, very good at one point in time. And then that's where the fees would actually make up for the majority of the divergence loss as long as we're executing it on an appropriate strategy. Now, real quick, I want to talk about my end goal with this Uniswap liquidity mining course and just my overall liquidity mining bundle. My goal is to give you the tools, resources, and education you need to get started in DeFi and start out with your portfolio, right? And I want to be able to do that for as cheap as possible and as sustainable as I can. And then after that, if you're interested in working further with me and actually building and scaling your portfolio, like the other 150 different people that I've worked with, that's exactly where my DeFi Legacy program will come into play. We've worked with many different individuals to help them build passive income portfolios through decentralized finance. Additionally, we've had AMAs with many different DeFi protocols, one of them being Polygon Labs, another one being Aerodrome and Orca and Radium, where we dive into actual strategy and how we can use these different protocols to earn great passive income and sustainable passive income from our cryptocurrency assets. And if you want more information about that, you can just head over to builderwealth.com. You'll be able to get some more information over there. But to dive back into simulating this Ethereum to Sol liquidity pool, we want to make sure that we are weighting more towards the asset that we think is going to outperform, but we shouldn't just have a guess. We should have an educated guess. So that's where we pull up the charts and we take a look over at the price of Ethereum as well as the price of Sol. And we zoom out, we look at the past year. So when we look at the past year over here, we could see that Sol started at roughly $18 and ended at roughly $135. Ethereum started at roughly $16.17 and now it's at $23.51. So obviously Sol has been the mover. It's been the outperformer. And if we look at more recent data, we can zoom out on this correlation chart because this chart right here represents how many Sol equal 1 Ethereum. So logically, we can think as the price is going down, that means Sol token is outperforming Ethereum because it's taking less and less Sol to equal 1 Ethereum. And when Sol's outperforming Ethereum, that could mean a variety of different things. Number one, Ethereum is going down, Sol is staying the same, or Ethereum could be going down, Sol could be going up, or Ethereum could be going down and Sol is also going down, just not as much. Or maybe they're both going up, but Sol's going up more. Or Ethereum's staying the same and Sol's going up. There's so many different possibilities. The point is Sol token is outperforming Ethereum. We need to factor that into our analysis. But more recently, over the past 45 days, that's where you can see that we have been pretty correlated. So that's what we want to pay attention to. And actually, by using that 90-day time frame, you'll notice our correlation is 40% instead of when we look at the 30-day time frame, 88%. But we would want to look at the volume history, make sure everything is accurate over here. Additionally, we want to look at the liquidity distribution to see where other liquidity providers have their capital. And assuming we're happy with everything, we'll plug in our deposit amount and save it to our portfolio. That's where we'll end up in the build section. And under the build section, we can add multiple positions. So as we go through the process of looking on the Discover page, sorting through these different liquidity pools, simulating their results, and then adding them to the build section, that's exactly how we build out a passive income portfolio. Now, assuming we deploy into one of these, we can actually start to track it directly on Metrics Finance as well. So I'm going to take a look at some random person that's earning a pretty high APR on this liquidity pool. This person's been in the liquidity pool for about 3 months, showing their fee APR at roughly 235%. And if we just click on this little button right here, we can open it up over on Uniswap, click the owner, that will take us to Etherscan, and then we can head back over to Metrics Finance with their address and paste it in the tracking system. And we can see exactly how they're performing. And if we end up deploying into that Sol Ethereum liquidity pool, we can go and paste our own wallet address in Metrics Finance, and we can see exactly how our own wallet is performing. So taking a look at this liquidity pool, this person has about $14,500 of capital allocated across these pools. You'll notice that they've deployed 22.5K. They've withdrew about 4.5K. So obviously their net deposit was about $18,000. They've lost about $3,500 from the prices going down. And that also includes any divergence loss that they had. But the thing is, they've claimed about $500 in fees, and they have a total of $250 in unclaimed fees. So they get about $750 in total earnings, which offsets some of their asset depreciation to put them at a negative 2805 loss. Now, you'll look at this versus HODL number, and you'll notice that they have a $781 profit compared to if they were to just hold their initial assets. That's because they have all these fees to help outweigh a lot of the divergence loss that they have in these liquidity pools. You'll also be able to see their total ROI, the APR that they're doing on their portfolio, and many other metrics just by looking at this information on Metrics Finance. So if we dive into that Sol Ethereum liquidity pool, we'll be able to see some even more metrics. Like this pool alone has lost them $1,700. They have about $430 in earnings from this position, and they're doing about a 50% APR here. We can also see a lot of other information. If you guys do want me to make a full dedicated video on how to track as well as manage your Uniswap V3 positions, drop a like, subscribe, notifications turned on, because that video will be coming out pretty soon. I hope you guys enjoyed this video. Once again, all the relevant links will be down below in the description. See you guys later. Peace out.